All right, in this lesson, we're going to be talking about FIFO, or first in, first out, as a costing method using the periodic inventory system. Now, before I get into that, just understand that we actually are going to break this into 3 videos. The first video is giving you an overview and understanding of the FIFO method. In the next video, we're actually going to show you a simple, basic example of how we apply FIFO. And the reason why it's basic is we don't have a lot of quantity of items to deal with, so there isn't a lot of calculation. So I'm providing this lesson as a way to just help you understand the mechanics of it first. And then in the third video, we're actually going to go through a more complex example, not too complex, but a complex example that has quantity associated. And so you'll have to do a little bit more work. So we actually broke this one and LIFO into 3 lessons just to give you a better understanding and a better learning opportunity of how FIFO and LIFO work. So just know that that's how we progress the next 3 lessons for you. So let's talk about the overview of first in, first out. So kind of an overview. First in, first out, or FIFO, utilizes an assumption that the inventory cost flow follows the order in which the goods were purchased or received from the vendor, not necessarily when the item was sold. So we are looking at this costing assumption based on what came in first, that's going to go out first, regardless if the customer takes that item or the item that just came in that costs us more, okay? So the way that I like to kind of think about it, it's kind of like the milk, right? If you are buying milk at a store, you're going to find the one with the latest expiration date, right? So you find the one with the latest expiration date, but that just came into the store maybe even a few hours ago. Well, the one that has the earliest expiration date probably came in a couple days ago. So which do you want? You want the freshest one. Well, that freshest one could have cost the store a little bit more than the one that came 2 days ago. Therefore, we should take the higher price and move that to cost of goods sold. But under FIFO, we're going to assume that the one that you took, the one with the latest expiration date, is the one that came in first, cost-wise, okay? So first in, first out. The cost of the first item is going to be the cost of the first out, regardless of the item that is actually taken by the customer. Now, to give you a little bit of understanding of when we would use this, we would use this FIFO, and we also do this for LIFO and weighted average, when we have low value items. So, a grocery store would use something like this. Many retail stores would use something like this because it's low value items considering the big picture. A car, high value, a printer, yes, it's expensive, but in the grand scheme of things, it's really a low value item. High volume in sales, typically we have a high volume in sales. So, a grocery store, they sell a lot of tomatoes. They sell a lot of lettuce. They sell a lot of milk. So it's harder to keep track of each one of those, which is why we can't do specific ID. Homogeneous items, meaning that they're usually the same. So when we talk about printers, all of the printers are pretty much the same. There is a different serial number on each one. We could keep track of it, but because we sell it in high quantities, we probably don't want to keep track of it and do specific ID for those ones. And it's harder to track cost of goods sold for individual items. So, when we buy 50 pounds of lettuce and then we buy another 50 pounds of lettuce, it's hard to keep track of these lettuces that cost us $1 a piece versus these ones that cost $1.05. So we don't care, and so we're going to use FIFO, and usually it's not material to the overall picture. So let me show you how FIFO actually works. So here's our example that we've been using over the past couple of lessons. We had 2 on our store shelves of these globes, and then we bought 4 more. So let's say the customer buys number 4. So they buy number 4, and we're not using specific ID, okay? We're just giving you the numbers just to give you the numbers. We're using FIFO. So the customer picks number 4, which costs us $16. But if we use the FIFO method, first in, first out, we need to take the cost of the very first item that we have. That's going to be what moves from inventory to cost of goods sold. So the very first one that came in would have been number 1. Now the customer didn't take 1, they took number 4. That's fine. They can take number 4 and go on their merry day, okay? But the cost that we're going to move from inventory to cost of goods sold is going to be $15, not $16. So $15 will be credit to inventory, $15 would be debit to cost of goods sold. So that would leave $79 in inventory for the company, and that would have $15 for the cost of goods sold in our account. So notice that the customer took number 4, which costs us $16, but because we're using the FIFO method, we're only going to move $15. The first in is the first out. Now when we think about the next item, this is no longer in play. Okay. Now, obviously, item number 1 is still on the shelf. Item number 2 is still on the shelf. 3 is on the shelf. 4 is on the shelf. 6 is on the shelf. But the next dollar amount that we're going to use is, again, $15. Then when we sell that second one, when we sell our third one, then we can move to $16. Again, regardless of which the customer takes. So that is how FIFO works. The first cost of the first in, okay, or the earliest, is the one that goes out first. And then we work our way towards the latest one that just came in. All right. So $15 gets moved, not $16. So hope you kind of understand the overview of FIFO and how FIFO works. In the next lesson, we're going to go through kind of a simple example. You'll see why when you see the third one, of why this is simpler and the other one is not simpler. But we're going to go through a simple example just to help you understand the mechanics of what's going on. And then in the lesson following that one, we'll show you a full-blown example that has to do with multiple quantities and how we deal with that one. So hope you enjoyed this lesson. We'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or click in the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.